Hi, everyone. This is January 7th, 2021, and we're going to be discussing our crystal ball for real estate, stocks, bonds, gold, cryptocurrency, cannabis, the economy in general, and also your personal budget. So hang on, I got a lot to share, and we'll get started in just a few moments. Okay, so let's get started. So again, as I said, it's the 2021 Crystal Ball Report. I'm going to give you the cliff notes, and then I'm going to dive in a lot deeper and show you the backup data. Again, when we're talking about, what's going to be happening or looking into the crystal ball, what you want to be looking at is data. Where's the data guiding us? You don't want to make guesses or haphazard or just rely upon what the broker salesman is telling you. You really want to look at what are the fundamentals. It's kind of like, trying to bake a cake without the essential ingredients. The data is the essential ingredients that are necessary in peering in that crystal ball and understanding what is on the horizon ahead of us, okay? So I'll give you the cliff notes and then we'll dive into the data because I want it to be easy to understand, but I also want you to see both where you can get the data, but also that this is grounded in reality, not airy fairyland, okay? So let's talk first about the economy. So in 2020, we definitely had a contraction, and that's going to show up again at the end of this month. Let me share the screen with you, and I'll show you what is predicted on that. So the contraction, so the recession for 2020 is predicted to be a minus 2.4% in GDP growth. So that is, we experienced the worst of it in the second quarter. The third quarter was a good recovery. We just ended the fourth quarter, and so we won't get the results from how the fourth quarter looked until January 28th. And that is the day where we'll also get the full year, and it'll say, okay, were we down 3% or 2%? Or again, the feds are predicting that our full year is going to be down 2.4%. Now, as you can also see here, they're predicting that we are going to have a decent recovery in 2021 of 4.2% GDP growth, which would be above the GDP growth of any year of the past administration. Now, again, it's got a lot to do with recovery as well. And when you compare it to what China is supposed to do, which is 8.2% GDP growth, then it puts it in a better perspective. So the US and many developed world nations are going to have a slower recovery than nations like China, which are building because they have so much catch up to do. So what does that mean for you? Well, it could mean that you should consider having a little hot slice in China or maybe Indonesia. Vietnam is predicted to grow one of the fastest and the farthest and the highest. So take a look at where I'm looking at this data, and that's the IMF. So if we go to the International Monetary Fund, hang on, there we go, I think, yes. So here it is, China, and this is for 2021 predictions, 8.2%. The US, as we said, we're already predicted at 4.2%. That's from the Federal Reserve Board. But let's take a quick look at Vietnam. 6.7%, so that's well above the US. It's hard to find a fund that's hyper-focused only on Vietnam. You're usually going to have other nations in there. However, you can get Indonesia, and that is 6.1%. So you might ask yourself, well, how are countries like Chile going to do that has a lot of natural resources? So slightly better than the United States. And again, you're going to see that a lot of the developed world, well, they're saying Canada's going to do 5.2%. Now, again, the reason that we have a pie chart rather than just buy and hope, or rather than market timing, is because there are certain things that can happen that can change the whole game. So in February of 2020, we found that the pandemic and the lockdowns and the closures, then it sent us spiraling into a recession. And between February 19th and March of 23rd, the Dow Jones Industrial Average had lost 35%. It was the fastest that anything had ever gone from, that high down 35% in history. And by the way, that's happening with a lot of these asset classes. So we will be looking at that. So right now we've got stocks at an all-time high. We've got Bitcoin at an all-time high. A lot of our cannabis stocks have tripled or quadrupled off of the lows that were set in March. Gold is at an all-time high. Real estate is at an all-time high. And what we know is that a lot of the fundamentals behind these things doesn't support that. So now, if you talk to your broker or you listen to a lot of the pundits on television, they're going to say, we're in a bull market, you want to be in, right? They're going to say prices, real estate prices are going to go up because we have such a small amount of inventory. What I would encourage you to do is to filter out a lot of that, because if you're listening to the news, you're always late. By the time it's a headline, it's late. If you're listening to your broker salesman, what they do is they tell you to stay in, stay in, stay in. And then at the bottom of the market, when you're finally disgusted and you're going to sell low, they'll tell you don't sell low, don't sell now, you'll be selling low. And that's the point when they're really right. So it is better for you to have a plan that allows you to have Bitcoin, that allows you to have cannabis, that allows you to have China, a hot slice of China or Indonesia or Chile or Colombia or cannabis, if you so desire, that's properly diversified and that you're able to rebalance once a year. Now, the reason for that is that if Bitcoin goes to, you had a hot slice of Bitcoin, and since the low in March, Bitcoin has gone up tenfold. So if you had one hot slice of Bitcoin and now you have, 10 hot slices of Bitcoin in your portfolio, and I'll explain what I mean by a hot slice a little bit more as we go on. But if you have now gone up tenfold, what it's telling you is, do you really want, now maybe that's half of your entire nest egg. Do you really want to bet half of your wealth? Or should you trim it back to one or two slices and sell high? And the good news about that rebalancing strategy, where you print out what you have, you print out what you do have, should have, and then you make what you have look like what you should have, is that you are buying low and selling high on autopilot. You do it once a year or 2 times a year or 3 times a year, not more, not less. And that is a buy low, sell high plan on autopilot. It allows you to capture your gains rather than be on a roller coaster. And every single one of these assets that I just mentioned that are at all-time highs have been a roller coaster ride for investors. And when we have these very, very high ascents, that seems to indicate that we have more quick descents. So it's like trying to catch a falling knife. So let me show you the data on that so that you understand what I'm talking about. So if we go over here to Bitcoin, you can see that Bitcoin is at an all-time high. But what you can also see here is that the last time it was at an all-time high, and it hit 20,000 right about then, which was in, I believe that was in 2017. And within 2 months, it had dropped down to less than half. It had dropped by more than half. And then it went way down and it stayed there and it stayed there. So we actually had, after the December 2017 high in Bitcoin, we had devastation in cryptocurrency. So in 2017, when it hit $20,000 and everybody was so excited about it, everybody was like patting themselves on their back and others were trying to get in. And then within a couple of months, it was destroyed. And especially anybody that was late to the game, we saw suicides in millennials and teens. It was really, really horrible. So just remember that when you have a plan that allows you to sell high, that also means that you can buy low. So rather than buying high at $20,000 a coin back in 2017 and then watching it sink to 8,500 and then sink even more to 3,500 and then feeling horrible or even suicidal, if it goes up, if you buy it at 10,000, it goes to 20,000 and you now have doubled your money, maybe you say, okay, why don't I just take it back to one slice like I really started with, and the benefit of that is that you've captured your gains, you doubled your money, you captured your gains. And if that $10,000 slice now drops by half or drops by 2/3, then it's saying, I wanted a full slice, not a quarter of a slice. Maybe I should buy more low. So that works really well with stocks, and it works with real estate as well. So it's kind of interesting because in the real estate, what you're seeing is that, they're saying that this is the most recent report from December, that existing home sales decreased, but they're saying, hey, home prices jumped to 15% more than a year ago. And so you might think, oh my God, so home prices are just going up, right? But what you have to do is you actually have to go back to the report from the month prior so that you can see that this home price of $310,800, which is very high and very close to the all-time high, is actually lower than it was in October. So it's up year over year, but it is starting to show a downtrend. And I'm in New York City right now. A lot of the buildings around here are 25% occupancy. Same thing is happening in San Francisco, where the home sales have gone up, doubled. Prices in San Francisco and New York are already down 5%. So this median home price nationwide is being pushed up by the flight to the suburbs out of the cities. So it pays you to really read the fine print. Also, again, if we're looking in the crystal ball and we're trying to imagine what's going to happen in 2021, well, there are a couple things that are really relevant for real estate. One of them is the moratorium on foreclosures and evictions. Now, that has been extended, but when it's let up, all of that money has to be repaid. Even if people are back to work and can start to pay rent again, they're going to have to repay what they owed. And so that's going to be problematic. And we are seeing that about 60% of US cities are unaffordable to the people who live there. In New York, the average worker would have to spend 100% of their salary in order to even rent or buy, still, even with the prices going down 5%. Same thing in San Francisco, areas of San Francisco. So we have a lot of cities where it's completely unaffordable. It doesn't matter whether you wanted to rent or buy, it's unaffordable. And of course, we have very high unemployment. So that doesn't bode well for real estate. So I would say, if you're tempted to buy right now, that you want to be sure that you're shopping in the shadow inventory. And I would encourage you to be a patient buyer, because there's a lot more distress there than showing up. It's not going to show up on the multiple listing services. You're only going to see the people that want to sell their home and want to sell it at an all-time high and know that or believe that they're in a seller's market. What about all those people that can't pay their mortgage? And by the way, we have, if you go to my blogs on real estate, you're going to see a different statistics there. So all you have to do basically to go to a blog is go to nataliepace.com/blog. And then you can do a search for just real estate. So real estate prices are going up and down. So if you take a quick look at that blog, you're going to see a lot more relevant information about what I just told you. The cities that are the hottest ones, the cities that are unaffordable, and also a little bit more about the shadow inventory and why that's not going to show up on the multiple listing services. Also, one other thing, if you really are interested in real estate, not only do you want to know about the shadow inventory, but you also want to know about the 3-ingredient recipe for cooking up profits. So I just wanted to remind you that we are going to have a real estate masterclass. That is going to be January 23rd. So January 16th through the 18th is the retreat. And then the following Saturday is our real estate master class. And again, the basic tenet is buy low, sell high. So you're buying high in real estate if you buy today. But if you shop in the shadow inventory, then it's possible for the diligent and patient buyer to get at least a 35% discount. So that's going to be helpful to you. But you also need to know what you can afford. You want to be realistic about that. And you also want to apply a business sense to it, because when you're going to buy low and sell high, you want to make sure that it's going to be more valuable in the years to come. So what's going to make it more valuable? And those are some of the things that we can look at in that real estate masterclass. So if you're interested in those, email info@nataliepace.com or call 310-430-2397. Also, if you're interested in our retreat next weekend, January 16th through the 18th, then let us know as well. And you can get additional information on nataliepace.com. So let me share a few more things with you as well. So cannabis. The House decriminalized cannabis on December 4th, 2020. And the thing about it was that we knew that Mitch McConnell was not going to get that vote in the Senate. With a blue Senate, there may well be decriminalization of cannabis. When Canada legalized weed, and that was in October of 2018, that's when all the cannabis companies went to their all-time highs. Now we already have, or very close to their all-time highs, but they were volatile too. So it's another thing where you really don't want to just buy and hold. There's very few assets today that you want to buy and hold. So if we take a quick look at canopy growth, and again, I'm looking at, its all-time chart here. You can see that right before Canada legalized weed, so they legalized it in October of 2018, right before it went to an all-time high. And then it actually started going down and way down, right? And then it went back up, and then it went way down again, and now it's back up. So this is, since, or in anticipation of that vote. And then again, the markets are what we call forward thinking. So if investors think the vote's going to go through and it's going to impact everything, they push it up before it happens. And then they might start selling even once it realizes, or once that actually happens. So again, your best strategy with cannabis is to try the hot slice as well. rather than invest everything in there. Now, one tip about cannabis is that it is a new industry. And so I would not recommend, there are funds out there that are cannabis funds. I wouldn't recommend them because the fund companies are not, long-term, well-established, well-capitalized companies. So you're going to have to do your own stock report cards and pick your own best stocks out of doing the analysis. And again, that's something we spend one full day on at the retreat, is learning how to use the stock report card and ask the 4 questions so that we can pick the leaders. So you can also read my blog about it and see which ones I think were the leaders. Again, the same thing applies. Just go to my blog and then look down for that cannabis blog. At the end of each of my blogs is a list of the prior blogs. So if you do that search, or if you just go through and look yourself, you can see it. Again, with Bitcoin, it's the same thing, is that a lot of people think, oh, well, it's going up, it's never going to stop, I'm just going to buy and hold. But that hasn't been a good strategy. And the reason for that is that this is not a currency, it's a trader's platform at this point. You can't have a currency that's worth $40,000 one day, and a few months ago was only worth $4,000. So it is a trader's platform, and there does come a time when traders want to sell high, and that can happen pretty fast. Same thing with this push up, is that we see people that want to buy, and then they start seeing headlines, and so they want to jump into the party, and they push it up even higher. And then we have the big hedge funds or big institutional investors that are going to want to sell. And when they start selling, if they're doing massive quantities, it can impact the price very quickly. So a few more things that I wanted to share with you. What could possibly go wrong? These are the most cited potential shocks over the next 12 to 18 months. This is from the Financial Stability Report that the Federal Reserve Board is doing twice a year. This is from the most recent one, which was in November of 2020. US political uncertainty. Yep. Corporate and SME stress and defaults. Now, that's going to take us to the conversation on bonds. So we're going to go through this list a little bit, and then we're going to come back. Insufficient fiscal stimulus. Well, that's definitely been the case. Recently, it was great in March, and then we had this long period of time where people have gotten burned through their stimulus money. COVID resurgence. Yep. That happened too. Stretched asset valuations way higher than it was even in November. So this is something to be aware of, is that all the things that they were worried that might have a negative impact, at least the ones in the top, are happening, right? So you want to take a little bit of a defensive stance, and we'll talk about that in just a moment. But I do think we have to spend another moment or two talking about bonds. Now, what's the cliff notes on bonds? The cliff note is bonds are illiquid and negative yielding. What does that mean? That means they're losing money. Now, bonds are typically what your money manager is going to do, or your 401k provider is going to tell you is safe. When you're losing principal, that's not safe. Safe is supposed to be preserve my principal and give me some money because I'm loaning it out to, investment grade entities. So that's not happening. And that means that your safe side is something that you have to take a serious look at, because you have to know what's safe in a world where bonds are losing money, where money market funds have redemption gates and liquidity fees, where this was a huge problem in February and March, and we've propped it up by printing a lot of cash, but that doesn't mean that the problem is over. So let's take a look at what it means, what I mean when I say bonds are illiquid and negative yielding. And I'm going to show you a chart from actually last December of 2019. So before the pandemic. And as you can see from this chart, if you had short-term treasuries or S&P 500 stocks or gold or euros or even UST bills, you were able, they're very liquid marketplaces. You could sell them if you wanted to or needed to. So that usually means that it's an active marketplace, and that the prices can be a little bit more stable. But even in December of 2019, bonds were really illiquid. So you could be sold into a bond. So, by the way, was the Dow Jones Industrial Average stocks. And those of you that have attended my retreats know that we have shown you why you wanted to lean into technology and why you wanted to underweight the Dow. So that's another thing that you learn. So when you don't have very many people that want to buy something from you, that means that the price is under pressure to go down. So when it happens with a bond, if you spent $1,000 on a bond and people say, I don't know if I want to buy that from you, and you really feel like you don't want it anymore. Maybe it's a 30-year Ford bond or another company that just got downgraded to junk. Then people will say, well, I'll give you 50 cents on the dollar. That's not safe. And over half of the S&P 500 is at or near junk bond status. And by the way, that does include a lot of financial services companies and banks that let themselves go to the lowest rung of investment grade because there was no penalty of doing it. They could still borrow money at maybe 4%. If you had that kind of credit score, you'd be borrowing it at 30% on your credit card. But anyway, and then people say, well, who's loaning them this money? And I say, you are. Because if you don't know what you own in your 401k or your IRAs and somebody else is managing it for you, chances are you have a lot of bonds in there. And you may have some that started out investment grade a year ago and are now junk bonds. I'm picking on Ford, but there's a lot of other ones that slid into junk over the last year. So this was December of 2019. So it's telling you that they were illiquid way back then. This is a more recent one from October of 2020. And you can see that corporate bonds are even less liquid. So they're really a problem. And by the way, that does include municipal bonds, especially since they're like 30 years. So if you have a lot of bonds in your portfolio, you need to learn what's safe in a world where bonds are losing money, because that could actually be a problem. I have a very high level bond trader friend who prefers stocks these days than bonds. And I say, why? The stocks are so overpriced. And he said, well, at least I know it'll come back. And he said, yeah, it will lose money, but at least I know it will come back. Okay. All right, let me see if there's a couple more charts here I wanted to show you real quickly before I show you. Yes. Okay. So I have shown you, if you've been listening to my other teleconferences, I have shown you this one recently, but this is, it's the blue and the green line, and this is stock prices. So the average price to earnings ratio is 16 or 17, and we are now over 36. And if you look at this chart, you'll see that the only 2 times in history, recorded history, that we have been this high for our stock prices was in 2000 and in 1929. You know what happened in the Great Depression. History books are full of that. But did you know that in 2000, that the dot-com stocks lost up to 78% between the March 2000 highs and the October 2002 lows? And it took 15 years to crawl back to even. Now you might say, well, it came back, but during those 15 years of hell, You know, you could lose a home, your credit score's in the toilet, you might be borrowing off of credit cards. And by the way, what that's added up to, sorry to be the spoiler alert on this, is that Pew Research has shown that the average person is actually worth less today than they were worth in 1995. And that is because of these very outsized recessions. So we have come back from the brink of horror in February and March, but it isn't because the economy is healthy. It's because we printed up too much money, and that money has to be paid back. So let me show you what it looks like. And again, I don't want, it might be so alarming that it just makes your brain go into brain fog mode, but I do think it's important to look at this. So if you go back to the blog, the first blog that you're going to see, again, nataliepace.com/blog, the first one you're going to see is, would you pay $50 for a grande latte? Are you overspending on your Tesla stock? So you definitely want to read that, but you also want to see this. That's the Pew Research chart I was telling you about. And I think I have, yep, the asset bubble chart. So these numbers may really blow your mind, but when we have an economy that's engineered by financial geniuses, we also have a greater risk of financial instability. Now, that's not my summation. That is Jerome Powell, the chairman of the Federal Reserve Board. So we are in a period of financial instability that has been propped up with printing literally over $4 trillion. And again, the numbers are staggering. We can come back. We had very high levels of debt after World War II, but we also had a growing economy and we had a lot fewer retirees. So it is more challenging today. We have to figure out what's going to be the product of tomorrow and invent it before everybody else does, and then sell it to the rest of the world. That's how economies are built. If we didn't have the internet, which came about under the Clinton administration, our economy would be doing a lot more poorly than it is. So we have to try to figure out what the next 21st century product is going to be, invent that, make it essential, whether it's clean energy, could be that. Right? There are things that could be very good for our economy and very good for the world at the same time. So I don't want to lead you down a path of doom, but I do want to lead you down a path of sober. So asset prices are bubblicious. There's a lot of economic storms on the horizon. We are in a pandemic. It definitely has been an ongoing nightmare that hasn't yet resolved itself. The vaccine is promising, and there should be a recovery in 2021, but that has already been built into the prices of real estate and stocks. And our bonds, as you remember from, let me see if I can pull it up easily. Hang on one second. Let's stop the video while I pull it up. Okay. So again, part of the reason, or one of the things that they are most concerned about, are the corporate and SME stress and defaults. That is exactly where the bond market is. So when a company has borrowed too much money and then they don't have the income coming in to pay it back, they have to declare bankruptcy. They can still continue operating and they restructure their debt. And that means that the bondholders are going to take a haircut on the amount of money they get back. They may get a little bit of stock in the new company. Mostly the old stockholders, their stock becomes toilet paper. So that is a real risk. It's a risk in airlines. We've seen a retail apocalypse. It's a risk in casinos. It's a risk in small, medium-sized businesses. I mean, go down the list. There's a lot of peril out there. When you have a lot of people that are out of work, they can't buy necessarily a lot of new cars. That's one of the reasons why the oil market tanked, and it's been propped up as well, because people are not driving as much. And also you have to be forward thinking, like what is going to come back? Are people going to go back to work in offices and have an hour commute? Or are they going to be able to do more work from home now that corporations know that they can? Is it even viable to go back to an office when you're still doing social distancing? How long will it be, even with a vaccine, before people are comfortable going back to an office? So these are a lot of things that are going to reveal themselves. But one thing is for sure, there's a lot of ifs in this economy. And the projections that are optimistic have already been overbuilt into the prices. So the last thing I'm going to show you is how you can benefit if prices continue going up, at the same time protecting yourself if they go down, and also getting on that buy low, sell high plan on autopilot. Okay, so back to now, all you have to do this is going to take us less than 5 minutes to do the sample. You can get these free web apps, the Thrive Budget web app and the Easy as a Pie Chart Nest Egg web app. Just go to nataliepace.com, and on the home page, right in the middle, click on that and you can download your own. Or obviously you can just email info@nataliepace.com and say, I want my free web app links, and Heather can send them to you, my assistant. So let's say, for instance, that your age is 35 and your annual income is 100,000, and your liquid assets, because you're just starting out, are more like about 25,000. That's about how much you have in your 401k. So your pie chart would look like this. Then it says, okay, you always keep a percent equal to your age save. We're going to overweight 20% because we're still in the middle of a pandemic and asset prices are very high. And then you're going to have 10 funds in your stock portion. And each one of those should have about $1,500 or $1,600 in it. Now, what happens is, if you then take what you do have and you put it into a pie chart format, you see, oh, I had, on my 401k, I checked off 3 boxes. I have bonds, I have large caps, and I have small caps, right? That would be, you only have 2 slices, and the bonds are supposed to be the safe one, although we now know that they're not that safe, right? So what you would see is, you'd be saying, well, I'm missing out on maybe value and growth. I might be missing out on mid caps. I'm definitely missing out on HOTS. So how can you fix that, right? Well, you could fix it a couple of ways. You could actually open up an IRA so that you can invest your HOTS in the IRA, because you're not going to find a cannabis stock in your 401k that you can invest in. You're not going to be able to invest in cryptocurrency in your 401k. So these other funds can allow you to do that. And again, that rebalancing, and when you rebalance, print out a pie chart of what you do have, do the free web app and print out a pie chart of what you should have. And then the fat slices, you sell them high and trim them back to the size they should be. The skinny slices, you buy more low. And that is a buy low, sell high plan on autopilot. All right, I think that somebody is trying to ask a question. So let me take a quick peek at the chat and I'll be right back. All right, so we're kind of wrapping up a little bit, but I wanted to just stress, you have to be the boss of your money. Nobody loses your money without your permission. And in a pandemic, with asset prices at an all-time high, and the way and the rapidity that things correct, you cannot afford to have blind faith that somebody else is doing this for you. You have to know what you own, you have to know why, and you have to be properly diversified. And sadly, in today's world, there's a lot of peril on the safe side. So you might say, well, that sounds like complicated. It's not. It's easy as a pie chart. Spend 3 days at the retreat educating yourself with the ABCs of money that we all should have received at high school. And you will start the process of transforming your life and taking charge. Your wealth is a huge part of your life. You can't always just earn more to make ends meet. At some point, you're going to retire. Also, if you buy high in real estate and your house drops by 20 or 30% or 50%, like it did for some people in the Great Recession, you could lose it. Your credit score goes in the toilet because your assets to debt ratio is screwed up, even if you're making your payments on time. So I do discuss all of this in the ABCs of Money. It's an Amazon exclusive. It's under $5 if you do the Kindle version. There's a section on debt, on the Thrive budget, on stocks, on bonds. It's the 4th edition is updated to include important information on the pandemic. Let me just show you how easy it is to get it. All right, so go to nataliepace.com, scroll down. If you're interested in the retreat, click on the retreat flyer and you'll learn more. You'll read testimonials, you'll learn the price, you'll learn all of that. Again, it is January 16th through the 18th. It's online, so you don't have any travel or lodging costs. But if you're at nataliepace.com, and again, you scroll down past the retreat, then you're going to see the books. If you are a parent, get the ABCs of Money for College. The Kindle version is under $4. You should start when your child is born, not when they're in high school. Start when your child is born. Learn that book now. It's essential. It's key. The ABCs of Money 4th edition. So I do encourage you to come to my website and click on the book cover from there so that you are assured that you're getting the 4th edition. And again, as you can see, the Kindle price is $4. If you wanted to get the paperback, you're going to pay 18 bucks. All right. I want to thank you guys so much. Oh, wait, hang on. Yeah. I want to thank you guys so much for joining me. I'm going to stop the recording. And if any of you guys want to ask a question or two, you can, and it won't be recorded. I will record my response if I feel that it can benefit everybody. All right, so thanks again, guys, for joining me. And I do look forward to seeing you at the retreat. I look forward to seeing you at the Real Estate Masterclass. If you have questions, email info@nataliepace.com. We like solving money problems. We keep you anonymous. We prefer to fix the roof while the sun is shining. So I would strongly, strongly, strongly encourage you to know what you own, know why you own it. One last thing, I do second opinions, and that can be invaluable to you because losing half of your wealth, for some of you, that can be worth hundreds of thousands of dollars or more. And that's what's at stake. That's what the last 2 recessions have cost investors. So don't ride the Wall Street roller coaster. Be properly diversified, know what's safe, and do your annual rebalancing so that you protect your wealth and you grow it. And it does work. And it also makes this process enjoyable. So again, don't think, oh my God, I'm going to have to get a PhD in economics. It's easy as a pie chart. You just have to learn the basics. And then it's easy as a pie chart because you're going to understand how this works. So allow yourself to learn it and it will become easy. And it's absolutely life transformational. If you haven't read the testimonials, they're from, hundreds of people. The books are over hundreds of thousands of people. So thank you, thank you, thank you. I love my job, but what I fear most right now is that people are too complacent. And again, I far prefer helping you keep your wealth than helping you to recover when you've lost your wealth or lost, 30% or 40% or 50%. I'll be here no matter what. I've been doing this since 1999, but I prefer happy endings rather than, look, we can recover and we can get things going again for you, but don't be complacent when the markets are high. Be a good steward of your money and keep your wealth. Rich people care about how much they're worth. Rich people care where they're invested. It's only the middle class and, average workers who don't know what boxes to check off on their 401k, and they are the most at risk. All right, guys. I mean, we saw that in February and March. The, White House had that meeting in January, and a boatload of congressmen sold their stocks high. We had an executive exodus that has never been seen. It did all of a sudden, Disney's, CEO decides he's just going to be the chairman, and he effective immediately. So, the informed money moves first. If you wait for the headlines, it's too late. Now's a good time. All right. Thanks, guys. See you later.